We're living in a time of what feels like pure market chaos, right? There's this frantic global gold rush happening, and at the same time, you've got these high-stakes chess moves being played between global superpowers. For any investor, this creates a dilemma unlike anything we've seen in a long time. So let's break down what is really going on. This quote, it really gets right to the heart of the puzzle. We see all these headlines about people flocking to jewelers, this absolute frenzy to buy up physical gold. But here's the thing, that's not the real story, not even close.
So that leads us to these two questions. Why is this happening, and what are we all missing? Because what looks like just simple market panic on the surface is actually a symptom of much deeper, much more strategic forces at play. And what's happening behind the scenes? Well, that's way more important than the rush you see on Main Street.
To understand any of this, we have to start with the big picture. I mean, the global economy is basically walking a tightrope right now. Markets are incredibly volatile, and those simmering tensions between the world's two economic giants, the US and China, have boiled over. This isn't just a trade dispute anymore. It's something way more serious. And this isn't just background noise. It's the storm that's shaping everything else. And that storm is sending investors scrambling for what they believe is the ultimate shelter, gold. But the story that everyone thinks they know about this gold rush, well, it isn't the real one. So let's peel back the layers. Okay, so the perception, right? That's what we see on the news. It's a local rush driven by individual investors' fear of missing out, FOMO. But the data, the actual numbers, they reveal a completely different reality. The real driver isn't your neighbor. It's a massive global surge led by the world's central banks. And they're not panicking. They are strategically hedging against geopolitical risk. And the scale of this is just staggering. In 2024 alone, central banks bought over 1,000 tons of gold. Just think about that. This isn't some impulse buy. It's a calculated institutional move to build resilient reserves in an incredibly unstable world. It completely dwarfs the demand you see at the local jewelry store. So the crucial point here is, this isn't about retail. It's about sovereignty. And that brings us right to the core of that geopolitical risk. The US-China conflict is the engine that's driving so much of this uncertainty. But even here, what we see on the surface, it's not the whole story. For years now, we've heard about tariffs, trade wars. It's all become familiar. But while the headlines have been focused on that, China has been quietly developing a powerful new economic doctrine, one that goes far, far beyond simple trade. The term for this strategy is reverse constrainment, and you should think of it less as a negotiation tactic and more as a straight-up economic weapon. By dominating the supply of critical minerals, the absolute building blocks of all modern technology and defense, China can effectively hit the pause button or even the stop button on Western production of everything from F-35 jets to electric vehicles. And look, this isn't just some theory in a textbook. This strategy is already being deployed, and it is causing absolute chaos. A perfect example is the market for a critical element called germanium. It's essential for things like fiber optics, advanced sensors, and military-grade lenses. Super important stuff. So, financial commentators, looking at all this chaos, reported the price of germanium skyrocketed to around $5,800, and they reported that price per ton. Now, I want you to pay very close attention to that unit, because the actual price was $5,800 per kilogram. That's not just a small mistake. That is a 1,000 times error. And this, right here, brilliantly illustrates the chaos of this new reality. The market is so fractured and so opaque that even the experts are getting it spectacularly wrong. There's this massive premium between the industrial price and the price investors have to pay to get their hands on the physical metal, all because of the supply choke point created by this very strategy. So we have this high-level geopolitical conflict going on. But how does that actually affect your portfolio? Well, the link is direct, it's quantifiable, and we can see it clearly when we look at how local markets react to political risk. It's really easy for investors to just say that politics is holding the market back. It feels kind of vague, right? But we can actually measure the impact in dollars and cents. There's a real, quantifiable cost to political instability. Let's look at a concrete example from March of 2025. A political shock hits. The mayor of Istanbul is arrested. Immediately, the BIST 100 stock index plummets, nearly 9%. In response, just to defend the currency from totally collapsing, the central bank is forced to sell $10 billion of its foreign reserves. That is a direct line from a single political headline to a multi-billion-dollar consequence. And the data confirms this isn't just a one-off event. This table shows the link with, well, mathematical certainty. Okay, so CDS, that's basically an insurance policy against a country defaulting. It's a measure of its risk. And as you can see, as that risk score goes up, the stock market has a strong tendency to go down. At the exact same time, the local currency weakens against the dollar. It's crystal clear. In this environment, political risk translates directly into financial loss. So, okay, we've deconstructed the problem: global tension, weaponized supply chains, and local political risk. In a world that looks like this, how can an investor possibly build a resilient strategy? Well, the answer, it turns out, is pretty consistent across all our sources. The core advice is simple and honestly timeless. Diversify your assets. You just cannot bet on a single outcome or a single asset class when the risks are coming at you from so many different directions. The only truly rational response is to spread your bets. So, what does that actually look like in practice? Well, this is a model for a resilient portfolio, one that's designed for the world we live in today. You've got stocks for long-term growth, bonds and deposits to offer some stability, gold and other metals act as that hedge against those geopolitical shocks we talked about, foreign currency protects against local devaluation, and a small allocation to alternatives, maybe crypto, can capture some unique opportunities. The key is that no single part is meant to win big on its own. The entire structure is built to survive. And that really just leaves us with a final thought. We are clearly in a new era, one that's defined by geo-economic conflict, where the real story is almost always hidden behind the headlines. The old playbooks, they might not apply anymore. So the question you have to ask yourself is this: is your portfolio built to withstand the shocks of this new world, or is it still designed for the calmer markets of the past?